back to the next edition of the Fireside Chat. I'm here with Bill and Shawn as always, and we're here to actually round out 2024 of our versions of the Fireside Chats. I'm excited to go through our content today. We've got a lot to discuss. Ultimately, we want to review 2024. We also want to look at what do we have anticipated for 2025. So given all of that, I'd love to jump right in. Bill, Shawn, talk to me a little bit about 2024. What were some of the big outcomes, and really what are some of the messages we should be relaying at this point?
I'll start if that's all right, Bill. 2024 was a interesting year to say the least. So it was a year that coming in, we thought we'd have a decent amount of uncertainty. That did play out. However, it didn't really impact equity markets. Equity markets as a whole benefited from better than expected economy, both consumer spending, which continues to hold in, as well as business spending, which is kind of pivoted a little bit higher than people were thinking. A lot of this driven by AI and just better optimism about things in the economy as a whole. I think we saw markets continue to trend higher and perform well, driven by underlying economic performance, as well as better than expected earnings estimates from most companies. So this combined to drive, low to mid 20% domestic equity returns, a little bit outperformance versus international. And that's on top of 20% or so the year before. As we head into 2025, things are going to get more challenging. We're going to see volatility increase. Valuations are elevated. I think policy uncertainty potentially throws a wrinkle into things. But overall, the economy has held in much better than was anticipated. Probably a point better in GDP than was anticipated earlier in 24. It will become more challenging as we head to 2025.
Yeah, and I know we'll get to that as we go further, but we've talked about it as an aside of we've had back-to-back 20+% years. As we start to look into 25, I know we're going to talk about what expectations should be. So I just want to put that on the table. But Bill, again, as we look back on to 24, what messages do you have for us?
Well, there's some messages of caution, right? As you alluded to, it's rare to have 3 consecutive very, very strong years. So I think expectations should be tempered. There's a lot of strong expectations from investors. Professional investors are starting to become more cautious, especially if you are looking at debt markets. The long end of the yield curve is starting to go up, which tends to signal long-term concerns for the balance sheet of the United States, specifically talking about the Treasury yield curve, as well as forward inflation. Just plainly, it's pricing in higher rates into the future. And that's a fairly new phenomenon. We'll get into that a little bit here in the forward as we go through. We've got a couple of slides for that. But the yield curve is relatively normal now. There's some aberration on the short end in terms of persistently high rates on the short end, which are likely to start to temper as well as the Federal Reserve continues to reduce rates. Now, just to clean that up, the Federal Reserve is likely to reduce rates one more time. And in our view, take a pause, and a lot of market observers are feeling the same, that it's going to be a wait and see come 2025. So the hope for continued rate reductions is likely receding.
I think that's a good summary. Is there anything else we should be taking away from 2024 before we move into what's coming?
It was a unique year. Shawn, I know you can get into some of the uniqueness of how we got here. It was an extraordinarily strong year with equity markets showing barely any interruption. There were 2 negative months, which is abnormal. I think April was down around 4%. And then 1 month, 2 months ago.
It might have been August.
Just a couple of months ago.
And I don't know if it ended up negative, but it had a negative connotation in the front part of the month.
So just really 2 points. One, I wouldn't even call it volatility, just a pause, and the other month of down 4%. Normally, markets sell off 10% in any given year. So even under normal circumstances, far below inter-year normalized volatility metrics. So a very easy investable year up and to the right. Usually when those years come about, we start to see people really have kind of a confidence build up. It's a false confidence. It's dangerous. And we've cautioned people for a lot about that. And there are a lot of asset classes getting a lot of attention right now. And the amount of rigor going into some of the decision making is probably not what it should be.
So I love to hear that, because I know we talk a lot about behavioral investing. And when we talk about that, coming off again a couple of really strong years, knowing that it really sets the mind towards expecting higher things going forward. What are you experiencing on behalf of the client base to be able to, dictate what the expectations are going forward? How are you managing that? What are you seeing? What are you hearing? And how do we start to reset those expectations going forward?
So from our practice vantage point, we're financial planners first. So we try to always anchor back to the financial plan. Where are we now? What's prudent? Try to anchor decision making in a plan. That plan then extends into the investment plan, right, as a subset of the financial plan. Emotions get in the way of that often. And we're seeing some of that. We're trying to create some rational decision making, rebalance down to neutral, reinspect risk profiles to make sure we're actually at a reasonable level of risk and we're not just getting greedy, right? People tend to get greedy when markets go up. And it's a bit of irony, right? I mean, logically, people can understand this. No one goes to the car dealer after they raise prices 20%, but everybody wants to go to the stock market after they raise prices 20%. There's a age old saying that when there's blood in the streets, it's time to buy. Nobody does it. They run away from it. They only get interested when markets are going up. And I'm speaking particularly of, mass generalization here in terms of just the general population and general investor community. It's very, very difficult to buy in friction-filled downturns, or in other words, when there's blood in the streets. It's very easy to try to trend follow because you don't want to miss out. It's all emotionally fueled. There's no real financial acumen to that.
I love that, which might position us really well as we go into our conversation on 2025 of where investors' mindset should be as we move forward in the future. So anything else on the 24 review that we need to touch before I jump into 25?
No, I think we did a pretty good job.
Okay. So knowing, again, we keep saying it, we're coming off a pretty strong year. As we look into 25, obviously changes in the political environment and the world environment overall. What are some of your assumptions, or what are some of the things you're planning for as we go into 25?
Political environment real quick.
Yeah, sure.
So we've had a lot of questions on the political environment, and our position is to evaluate, right? Our goal, our mandate is to evaluate policy, and it's a difficult environment. There are some inflationary policies. There are some cost reducing policies or deflationary policies. It's a difficult handicap right now. It's not a clear one versus the other. The scales are literally, there's weights on both sides of the scales. And so the answer is in an uncomfortable statement of, we don't know. We don't know how the tariff negotiations are going to go. They could be inflationary or disinflationary. They could be pro-business or they could be anti-business. And we're all going to have to wait and see. It is not a knowable. It's not an investable. In other words, changing allocation or changing investment strategy is nothing more than gambling at this point, and we do not participate in that. So we are going to hold fast to allocations, make sure risk profiles are inspected, make sure we're taking the risk we're comfortable, and we're getting the risks and the returns that for the allocation that are being facilitated.
Shawn, what would you add?
Yeah, and I'll add to that. Bill brought up a good point regarding all what you're hearing in the news about the tariffs and all, whether they're inflationary, whether they even come to fruition and whatnot. Inflation will be the key item for the Fed to focus on. We talked about we're going to get a rate, the 25 basis point rate cut tomorrow. Into next year, the expectations are for 2 to 3 of those. It's all going to depend on inflation. If inflation stays in this kind of high 2, low 3 range, I think the Fed can continue to cut. If it ticks back up it becomes problematic. It doesn't have to get to 2. They've said that I don't think they should be at 2 personally. I think it should be closer to 3 anyway. But absent that, if it hangs out where it is right now, I think it gives them more impetus to continue to cut. But if it ticks back up, which policy can drive it, if these tariffs do come into play and they're higher than maybe anticipated, that can start to lift the inflation expectations, and that will make the Fed's job tougher and harder for them to potentially continue to cut. So it's going to be a big thing that plays out in the front part of the year. We really won't know for another month or so, maybe even into early February, how that is. It's all posturing right now, but that will play very big in the market. The market's going to be fixated on inflation again, where we felt like the past few months we've gotten away from that a little bit, but the market will refixate on inflation as a big key for what happens in 2025.
I think that makes a lot of sense. So as you think of your client base and you think of, some of the things we know and we don't know going into 25, what are a couple of the key messages that you really want to deliver as we prepare for 25?
Well, I think I'll start, Bill. Expectation wise, we need to moderate expectations. We're just most likely, I'm not going to say we're not going to, but chances are we don't get a 20-25% domestic equity return landscape to play out. It may be flat. It may be slightly negative. It may be slightly positive, but we're not going to get, it's just elevation. We've got valuations that are too high. They're elevated too much. We've got a decent amount of uncertainty. We say volatility, and I think people think that we just continue to harp on volatility and never comes to fruition. It comes to fruition when we least expect it. It will show up in 2025. I can guarantee it, even though I know we're not supposed to make guarantees. So I think we need to be fixated on that, expectations need to be moderated, especially on the domestic equity side. And then we need to start, are there other places? International's underperformed for a long time now. I'm not saying that it's going to outperform, but maybe it performs more in line with historicals, and that creates an opportunity. I'll also say there's been certain sectors that have been left behind while other sectors have outperformed. I'd love to see a sector rotation and a more widening out of the market. We saw that over the past couple of months. It seems to be receding now as we go into year end with, tech, consumer discretionary, and communication services leading. I'd like to see it widen out again because I think that's healthy for the market as a whole. We don't overload into any specific sector baskets anyway. We try to smooth out and keep things even. But I do think at a whole, if you could widen out the market, that's just a positive for the market as a whole.
Yeah. So if I'm hearing you correctly, Shawn, a couple of things out of that is, number one, again, look at the variety of markets that ultimately play here, but really go into this from a behavioral standpoint with an understanding of, hey, we could be at flat, right? We should kind of set off of that expectation, and then we'll work from there.
Yeah, it's a little bit more of that I've eaten tomorrow's lunch today type thought process. Yeah. And I just think, our job is to make sure that we rebalance back to neutral. We may have accounts that are 3, 4, 5% overweighted equities. Now is a great time to take that equity off. My gut says going forward that we're just better positioned to get back to neutral than to stay elevated with our equity weightings. And I just think that's something that we're doing a lot of into year end right here.
Yeah. Bill, what would you add?
Just to be clear, when you say take equity off, you mean rebalance back to neutral.
Yeah.
So, I feel like I'm probably the downer in the room, but look, we haven't had a recession for a very long time. The theory that I've been working off of is that, we filled in the recession that was going to happen in 2020 when COVID happened. We threw $4 trillion into the hole and pushed markets forward, fortifying consumers with an excess amount of cash of roughly $2.1 trillion at the peak. That's a trillion with a T. That is now gone. Consumers have spent all those excesses, and now they're debt spending. And so that's one sign that it will help markets in the near term because they're leveraging up and continuing to spend. There's a reckoning at some point. Recessions are natural. They're generally a pause moment in markets, and we have basically avoided one even through COVID. And so now the question is, when and how will the next one come, which is unknowable, but it's always good to be prepared for something. It's sort of like that emergency bag that we all have in our trunk or should have in our trunk that our parents told us to have with jumper cables and a blanket and a flare in there, right? Never leave home without it. And this is similar. And so to be fortified and ready for a recession, knowing that you cannot time it, knowing that you cannot see it coming, knowing that it's confirmed in the rearview mirror is just prudent. And understanding that 20% returns cannot continue to happen on equity markets is also prudent. To temper expectations, to, in my view, if we could put up a middle single digit number in 2025 and give the market a rest while consumers normalize their balance sheets, that would be an extraordinary victory. But if consumers continue to spend, that will likely be one of the leading indicators into a recession. They'll overspend their balance sheets. Eventually, they will have struggles continuing their debt service. That will lead to less goods being purchased on a marginal basis, which means corporations will probably start to lay off. Corporations start to lay off. That will likely trigger a recession. And then we'll have debt defaults and certain other workouts that would happen naturally from that. Those are typical to intramarket cycle activities. They're natural. Again, can't plan it. Don't know when the consumer is going to be maxed out. Don't know when companies will stop building and expanding. It's very, very difficult to time, and the government only confirms it in the rear view. So that's my soapbox. Be cautious. Caution does not hurt. Stretching, guessing, betting, that whole FOMO thing, if you're missing out, emotions generally fuel bad decisions, right? I'll pick on Jim for a second. How analytical are you if you're fueled by emotion?
Very little.
It essentially shuts down that part of the
Exactly.
brain, right? So biologically, we're unable to actually discount risk if we feel emotionally compelled to a decision. You marginalize it, you minimize it, you basically don't even factor it in. And that's hopefully where we come in to introduce sound advice, anchoring to the financial plan, making sure that in context, everything is sound.
So as you look at some of the conversations that you will likely have in 2025, what do you think some of the messages are going to be? And again, I think it's just an extrapolation of what you've already said, but is it a lot in your mind of, let's stay the course? If anything, let's put money in. That to your earlier point of, blood in the water, now is the time to be able to make some of those investments? Or are there other things that you anticipate?
So there's an old saying that nobody ever got hurt taking a profit, right? And so that's some of it, right? We've had extraordinary years. Now, we do have to balance taxes, so I'll kind of hedge that last comment of nobody ever gets hurt taking a profit, but be prudent, right? Don't assume that because we've had 2 good years that they're just going to continue perpetually. It's unlikely. And the farther we go, and I'll go back to the 1999, 2000 bubble bursting in the dot-com era. There were 4 extraordinary years, and then the bubble burst in tech. And assuming that it will persist forever is usually a major error. And I remember all of those conversations, and I see elements in certain areas of those conversations with clients that they got to get on the train. And that will likely persist for a while. And to be frank, regardless of what happens in early 2025, we tend to, in my observational research, I don't have any real data on this, but in my career, I've somewhat observed that people have about a 1-year lag in how they feel about markets. In other words, if we have a bad year, regardless of if the market's going up 20% the following year, we still feel the hangover of the prior negative. Likewise, we still feel the euphoria of the prior positive if we're in a year that's not doing so well. And there's a bunch of justifications that start to happen to us as humans around that, right? It's a temporary pause. I still need to commit, things like that. That's where a lot of what we do in terms of not only the technical aspects of portfolio construction and financial planning, but the behavioral aspects of just recognizing how we're all failed as humans, right? We're wired incorrectly. We talk about it frequently, about the limbic system. And I know I'm droning on, so I'm going to wrap this up. But, the limbic system is your fight or flight system, and I'm going to let you finish this up, Jim. It literally wires us to respond incorrectly to market stimulus. So that's one of the biggest things we try to sense and work with.
Well, and I understand that's why you're so good at what you do, right? It's being able to manage the mindset, the autonomic decisions that we're geared to making, to be able to reset of, okay, what does logic actually tell us and where do we need to be? So completely understand that argument. All right, so from a 25 standpoint, I think we've kind of laid out what we can anticipate. Is there anything else, any other messages that you would leave our viewers with?
I think we've covered most of it.
I got one. Have a great holiday season. Enjoy the new year. Be safe, and we'll see you in 2025.
Absolutely. Happy holidays.
Take care, everybody. Bye, everybody.